happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Hi, Chair Powell, Janelle Martin from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates, now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago. And we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit, it's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there was job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed a quite large shift of rate cut expectations relative to March. It's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025, 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
James Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability for potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of our sort of very important concept in economics and what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow moving forces. And there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been the policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy rate now for almost a year.
So just to follow up on that, I think what's curious in here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you had the benefit of inflation coming down, really fast actually last year, and you will see what the rest of this year brings. So these dynamics can continue as long as they continue. I mean, ultimately, the question is are you down to demand? And we don't know that though. I mean, we look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market, and your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that. But so far, they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing of the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Thanks. Chris Rugaber, Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts, McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening of financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about it at that time, but it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. we're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't, it's only one reading. You don't want to be too motivated by any single data point.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Ken with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. Where people experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. The inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year. I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are, people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents. It has to get worked off, and that may take, several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's, many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up, credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as a spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Hi, Victoria Guido with Politico. You mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move, to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So And also the fact that we look at all of the whole situation. So, you know, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not gonna. Yeah, I mean, I can think of things that would, many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Rabic with The Economist. May I ask, you mentioned with the slightly higher PC reading earlier this year, that wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that, it looks like May will be quite good for PC as it was for CPI. Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we have bad ones, but no, it's not like that. It's the whole, it's going to be the totality of the data. The labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have noted that the market should determine the exchange rate, but Japan and some emerging market are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable, and you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative, and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So.
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
That was Fed Chair Powell following the decision on interest rates. Welcome to Closing Bell. I'm Scott Wapner. Let's show you the markets right now. They have been extending their record highs today. The S&P and the NASDAQ on track for new closing highs. The Dow is at the highs of the session now, even as the Federal Reserve has taken its own forecast for rate cuts down to 1 this year from 3 back in March. As is customary, we are joined exclusively by Jeffrey Gundlach. Only today we are live in Los Angeles with the CEO, CIO, and founder of Double Line Capital. Thanks for having us here. It's good to see you.
Thanks for coming, Scott.
So what do you make of what you saw, and more importantly, what you just heard? The big news, obviously, is the forecast down to 1 cut from the 3 we had in March.
That's right. I think that's what will be remembered in this meeting, in the history books. In past meetings, there was new ideas that were brought out. Remember, we had supercore inflation was brought out at one meeting. There was 3-month and 6-month annualized was brought out. This one, they actually had to do the SEP, and so they had to adjust things a little bit. But he was remarkably vague in the Q&A session, basically saying, I don't know what's going to happen. And he did mention that he can't wait for the labor market to really show signs of weakening, he doesn't want to break things just to fix them, let them break and then fix them. But I think that's pretty contradictory. If the labor market is strong and stable, and you're not going to wait until it starts weakening, I don't see that. I don't see that to be consistent with dropping from 3 cuts to 1 cut. But the market seems to be completely focusing on his tremendous balancing act. He used the word balanced a lot of times between the labor market, which is weaker but not weak enough, and then the inflation numbers, which have kind of stalled out at about, well, it depends what you look at. There's so many different inflation numbers. But, you know, I think that the idea of getting to 2% is really interesting. And he actually brought this up very late in the press conference, and that is that the core CPI was at 2% for a very long period of time, almost in a perfectly linear fashion. And that happened all the way until, of course, the pandemic. And then we had this spike. And so now the inflation rate is more like 2.5% for the past 20 years, and almost 3% on the core PCE for the last 10 years. So you can kind of pick and choose what inflation data you look at. One way to think about it, if you're really serious about this 2% idea over the long term, and he did bring it up, you would actually need inflation for the next 10 years on the core CPI to be 1% per annum to get us to a 20-year run, to just back to that 2% trend that was in place pre-pandemic. So I actually think implicitly what we have here is a growing acceptance of a higher baseline inflation rate. It seems that he said 2.7 is not that bad. I think he was quoting the PCE. So I just feel like the market is very fond of the fact that hikes still sound rhetorically like they're completely not being considered.
You've said most recently you're still looking for 1 cut this year. Does that hold today, given what you saw in the data and what you just heard from the chair?
I actually think I'm less confident there'll be 1 cut this year. I almost feel like the Fed is going into a reactionary mode. They're going to react much more volatilely and quickly, I think, if the data starts to get bumpier. I just feel like he's almost a trigger finger, it seems to me, on deciding whether inflation is going to be acceptable, they can cut rates, but what if, what if there's some other problem? I feel like he would possibly go to, in the future, possibly go to Fed hike rhetoric. I think that's a potential.
Even with what he said today about the report, the CPI today being better than almost anyone expected, those were his words.
Better than anybody expected.
Said they made good progress, we're getting good results here. He said as well, it feels like he's building the case for cuts.
Certainly, they've been tilted towards cuts ever since, I would say, November 1st, which started everything off in this rally. It was reinforced, I would say, at the last meeting, where it was quite a surprise to the market. There was a fear that there would be more talk about potential hikes, that it wasn't all skewed towards rate cuts. And I feel like that was walked back a little bit today, but you have to get out a magnifying glass and look at the rhetoric. But I don't know. I think that the labor market is weakening. It's not weakening in a way that's alarming, but the unemployment rate has been going up. The household survey looks pretty bad. I mean, part-time jobs is negative. Full-time jobs, rather, is negative year-to-date on a household survey. And he tipped his hat to the fact that we have highly contradictory data. That's because we have a highly inconsistent economy. And I think that's a theme that's been developing in commentary across the board, that some levels of the economy, those that are needs-based consumers, are getting crushed because the things that you need are still very high in price and they're not going down. It's the same thing with the money supply. We talked about this before, where the M2 was spiked dramatically in the pandemic response, and then it went negative year over year, and everyone says recession's imminent because it's negative. But the amount of money is still a lot. M2 is still way above the pre-pandemic trend. And although people focus on this excess savings theme, the fact is that the M2 money supply is growing again, and it is still way above the pre-pandemic trend. So there's still sloshing around. It's just not evenly spread in the economy. I've been using this analogy. It's from not this CPI report, but from the one from last month. I don't have time to do the slicing and dicing because we're doing a show today. But the inflation rate is very different depending upon what your lifestyle is. One thing, used cars was the big drag on the CPI a month ago, but used cars don't affect anybody. They probably affect Hertz and Avis, but they don't affect even 20% of the population. Whereas auto insurance, that thing's beginning all to play, and it's up 22% year over year, well, that affects every single person that drives, because you are forced by law to have it. And it's not a one-time buy like used cars. It's every day, in essence, you're buying your own car insurance. Same thing with health insurance. What's happening societally is we're getting greater dispersion of outcomes. For example, if you just put 4 kids through college over the last 10 years, you've had a massive inflation rate if you were paying for your kids' college. If you're, in my situation, I'm doing assisted living for my parents over the past 11 years, the price has gone massively higher. So the inflation rate that people are experiencing is very different than the indices, the on average stuff. And I think that's true across the economy. And I commend Jay Powell for talking about that. The fact that the lower 50% of our economy is very, very stressed out. And the higher under the economy is obviously doing better with financial assets, doing better.
Do you not believe that the economy is as good then as Chair Powell would suggest today? He used the word solid on numerous occasions. He talked about parts of spending are picking up, the consumer is still strong, and the labor market is, by all metrics, still healthy.
Yes, I don't know by all metrics. One thing that's happened is we're talking about economic data reports, and they're always backward looking, and then we get monthly data that ends up filtering into the quarterly GDP reports, and the monthly data is observably weaker over the past 6 to 8 weeks. Like the economic surprise index has gone way down, economic momentum is down, the unemployment rate is up to 4%, almost, it's 3.96. But this has been a very long time period of the unemployment rate being stable. It's 28 months now that the unemployment rate has been at or below 4%. This hasn't happened since 1967 or 1968.
Well, there are many people who thought we'd be in a recession by now.
Yeah.
Well, we're not, and they thought the unemployment rate would have spiked a lot further than it has to date.
Well, the labor force is shrinking, the legal labor force is shrinking. And so the labor participation rate is going down. And so when you have the labor force participation rate going down, it causes stresses to the economy because you're having more and more people that are takers rather than payers. And I think that that's very slow to evolve, but I think that's underway. And I do think that we're going to see, if I did my own SEP, I would not have the unemployment rate where it is now at year end. I think I would have it more like at 4.4. And I think that's enough to cause a little bit of consternation about the lack of this. It's almost like we've had this sort of Goldilocks-ish stability in GDP and in the inflation rate after the big scare. But inflation will come down, I think, further, as long as the quit rates continues to fall, which has been falling rapidly. It's not at an alarm level yet. I think that if shelter prices come down, which they should, because the inflation rate was in 2022 was way higher than what was reported. The shelter and housing was grossly understated because of the way it's constructed. But it's going to come down because the national rent roll is now 0.6 year over year. It's nowhere close to what they show is the shelter, the OER. If you actually want to be sort of optimistic about the 2% goal, I can do a magic trick for you. There's actually not a terribly complex way of looking at the inflation rate that gets you to 2% right now. It's just core CPI less shelter. That's it. It's at 2% right now. And shelter's coming down. The other thing is if oil prices go down, we would see further relaxation on inflation. Right now, the correlation that's the strongest for, say, the 10-year Treasury yield is WTI. It's been extraordinarily strong. If it goes down, if for some unknown reason oil goes lower, and I'm not sure fundamentally it's supposed to, but I just have this sneaking suspicion that there's going to be organized pressure to get oil prices down for the election.
The chart is interesting that we're looking at of the 10-year yield actually moving higher following the statement. And Chair Powell, we were 425 earlier today, so we're moving up a little bit. Steve Leisman, our senior economics reporter, has come out of the room now. He did get the first question to the chair. And I feel like once again, Steve, we had a more hawkish statement, maybe a more dovish Fed chair. You asked the question too, that the statement and even the forecast for PCE by the Fed, in your words, seems to ignore the better data that we've gotten recently, including today. Were you surprised by that?
I was, Scott. It feels a little bit like the Fed came out of its hole in March, saw its shadow, and kind of went back in and said 6 more months of inflation. I think they sort of ignored the progress that we've had in April and May. Now, I get that they were somewhat spooked by what we saw in January through March, but it seems increasingly clear to me that what we saw in those 3 months was very much residual seasonality. Jeff was talking earlier about the change in motor vehicle insurance that now has come off. It did seem like a beginning of the year adjustment to price or catch up from the increase in auto prices in the past. And Jeff brought us something really interesting that I'm just wondering about right now. I'm wondering if indeed the Fed even has a bias to cut anymore. I don't know that. It feels a little bit like there was something of a coup of the hawks inside the committee when it came to the statements. And no, forget May, forget April. All that matters is January, February, and March. And then also forget what we're seeing, and Jeff talked about this too, this cross. Inflation's been coming down. Unemployment's been ticking up to 0.6. I get that the payroll number was high, but when we look at the unemployment rate to see the ratio of those who want jobs to those who can get them, it has been ticking up. Jeff's forecast of 4.4 for the unemployment rate, by the way, is exactly the forecast from the Fed survey we had. So yeah, there is this tendency now. I think you're right to pick up. If things did change, if the data showed this weakness, Powell would change. But right now, the forecast of the Fed and the statement seems to me to be really seriously, Scott, leaning on the hawkish side.
Yeah, really good insight, Steve Leisman. Thank you. You want to opine on that?
I think he's just spot on in just about everything he said. I also want to point out that, and I think he kind of alluded to it, but didn't fully articulate it, there's a seasonality to the inflation data. And it's strange because it's supposed to be seasonally adjusted. And yet, over the last 14 years, on average, and it happens most years, so it's not that it's just the average, it's also quite consistent over time. The first quarter is by far the highest inflation quarter, followed by the second quarter, followed by and weaker in the second half. And that fact was ignored during November 1st when they did the rhetorical pivot by doing the 3-month annualized that we're taking second half types of numbers and analyzing them. But it's quite likely that that seasonality will continue. And particularly, Steve's right on when he says the auto insurance thing is very important because some things are adjusted at year end. That happens with rents a lot, it happens with auto insurance and things. And I believe that we're going to see the inflation rate settle in on the headline CPI. We have a model that's quite simplistic, that's been very helpful over the years. We think it's going to settle in at about 2.5% to 2.75% on headline CPI throughout most of the rest of this year. So Chair Powell said, hey, 2.7 on the PCE, and he didn't quote it as the PC, just call it inflation. He seemed content with that. And if this headline CPI settles in on that, you would think that there would be, maybe would have gone to 2 cuts instead of 1. So the 1 does have a little bit of a hawkish tilt to it, but the contextualization with all of the rhetoric shows to me that I agree with Steve. I'm not really sure that they're biased to do anything anymore. I think that they're waiting and seeing, and it was abundantly clear by the repetition during the press conference of, the dual mandate. He's been on this theme for the whole hiking cycle, but he repeated himself kind of and astonishingly many times today.
So if you don't know truly then what the bias is anymore from the Fed, then what investment decisions would you make as a result? And would any of your prior change as a result of the ambiguity you're seemingly suggesting exists today?
We've been for a while now operating under the investment theme of higher for longer from the Fed. And higher for longer means that you can expect very good returns out of certain parts of, say, the fixed income market. Like today, double B bank loans, I talked about this in past appearances, double B bank loans are very low risk, and they have a spread that is about 290 basis points over SOFR. So you're talking about yields with an 8 handle. So even if the Fed cuts once, twice, you're still talking about something that is very attractive, and the risk is very, very low. And I think that what I take away from Powell's Q&A today is that you're probably going to be earning that 8 handle yield for a while now, and the default risk is very, very low. So the bond market has been incredibly stable. We've seen the yield curve at negative 45 basis points or so, 2s, 10s, and it's still there. With all the gyrations that we've had, we had the 10-year Treasury go from 3.9 up to 4.8. The yield curve didn't move 2s to 10s. I mean, at some days, but on a trend basis.
Sure.
And now we've had the rate come all the way down to 4 1/4, and it's still at that level. So the market seems to be saying, I don't know what's going to happen either, but we're biased to think that the economy's going to weaken, and the Fed, on the margin is more likely to cut. But I think the odds of cuts obviously went down today, because when you go from 3 to 1, that's newsworthy.
Then why is the equity market, do you think, reacting the way that it is? We're likely going to put in new closing highs for both the S&P and the NASDAQ once again.
Well, yields are down a lot this week on the 10-year. That's spurred things. The inflation data today doesn't hurt at all. The stock market really needs rate cuts, I think, to sustain, or they need the earnings projections for the coming 12 months, which have been upgraded. I think that's helped a lot. They're up about 14% now for the S&P 500. That's a big number. And I worry about that, but that's in the psyche of the market right now.
Does it need the rate cuts, or does it need the belief that there are going to be eventual rate cuts? And frankly, nothing that the Fed chair said today leads you to believe that the next move is not a cut, does it?
No, the overall takeaway from today's meeting and press conference has to be that there's more likely odds are that the next move is a cut. But those odds have gone down. And I also think that I'm just going to repeat this, I think the rhetoric from the Fed is going to change fairly dramatically between now and year end, because I don't think this data is going to be sideways to the extent that it has been. I think the economy is going to be weakening. I think employment's going to go up to 4.4, and I think that's going to be enough to change the way they're looking at things. But when we started this year, I remember the pricing in the bond market was 7 cuts this year. Can you believe it? 7 25 basis point rate cuts. That just seemed crazy.
Feels like an eternity ago.
It seems almost impossible people could have thought that. And yet, the bond market hasn't really changed very much this year.
But are rates then done, for the most part, going up if you think things economically are going to weaken a bit from here?
My game plan remains the same, and that is that rates peaked for this cycle back in October of 2022, I guess it was, or 2023. But 2023, they peaked, and I thought they would start falling as the inflation rate came down, and that happened. And I think we've seen the peak for this cycle in the longer-term bond yields and probably in the Fed funds rate. But I do believe that when the next recession comes, the Fed will act much more aggressively than they think they will. And I think that it will be problematic, and that we will see significant reactions at the long end, to inflationary fears and excessive treasury supply. The one thing that's helping the bond market And what hurt the bond market last October was there's tremendous net supply. There was auction after auction. The bond market couldn't digest it. That's down a lot right now. So the supply problem in the near term isn't that bad. But I think in the economic weakness that will come one day, it's like waiting for Godot, you know, waiting for the economic weakness. But when it comes, I think we're going to have a scare on the government reaction being inflationary again.
You still sound skeptical that Powell is going to be able to pull this off, that they're going to get the soft landing that the market seems to be placing its high hopes on. Are you still looking for a recession?
Yes, it's a question of when. It's been a long time coming. Many of the recession indicators flagged a year or 2 years ago, but this was a crazy cycle with all that government spending and then the retraction of the liquidity. But I felt like Powell himself was less confident today than I've heard him, I'd say, in about a year.
Interesting.
Because he seemed to have some mojo back in November, and I think he seems to be pretty confident. The earlier meetings this year, this was like an economist talking, not a private equity guy, which is more of his background. You know, he's sort of like, on the one hand this, on the other hand that. I don't know what to look at. It's not one thing. I just felt like he said almost nothing today.
So well, doesn't he have to balance he has to balance the risks, right? He said that specifically about cutting too late, but he's cutting too early.
But clearly in past meetings, there's been meetings where he's shown up more hawkish than people thought, more dovish than people thought. This one, he just seemed a little bit. Wanted to keep all of his options open. So that's why I think Steve is on to something, which is I'm not even sure that they're truly biased to cut. They're sort of biased to be biased to cut, is I think where they are.
Let's run through a few investment ideas. Gold, we talked about it before.
Yeah, I've been bullish on gold all year.
It had coming off one of its worst day in some 3 years.
Well, that was the employment report, yeah. But it's back up to 2,300 plus handle, still quite strong, so 15-17% year to date. I just think it needs to take a break. I mean, it went up over 20% in about 4 months. So to take a break, but I believe gold is a worldwide economic thing, central bank thing. I think it has to do with worldwide indebtedness, and I think gold should be accumulated on weakness for sure, and even at the level today, I think it's worth dollar cost averaging. I own gold. I've been positive. That was my real asset pick at our double line roundtable around first week of January. I had no idea it was going to go up so much, but that's what markets work, you know.
India seems to be a hot pick lately, though you've been talking about it for quite some time. Do you still like it?
Love it for the long term. I wouldn't even look at it. I would buy it and don't open your statement, because when it goes down 20%, and it will from time to time, don't sell yourself out. I think India will be the strongest. The Biden administration, the president himself, repeatedly makes the comment that the U.S. is the strongest economy in the world. That's obviously not true. India is probably the strongest economy in the world, at least on a present basis and going forward. Their manufacturing economy has a lot of tailwinds, and their demographics have a lot of tailwinds. So that's my number one long-term buy and hold. INDA, it's an ETF. I don't have anything to do with it, but you can buy that.
Speaking of President Biden, you've been critical of him. You posted on X recently about what you called chaos at universities.
Yeah.
The wars in Ukraine, Gaza, the interest expense on the debt.
Yeah.
Does that mean you're supporting former President Trump in the upcoming election?
I've never supported a presidential candidate personally. I've never endorsed one, and I don't give any money to them because I've got other things to do. But I think the problem that the Biden administration has is they've glued together a group of constituencies, and a lot of them are ethnic groups, a lot of them are socioeconomic groups, a lot of them are immigrant versus rural versus city versus rural. But what's been revealed with the Israeli-Hamas situation is when you glue constituents together, they're not monolithic, and they don't always agree with each other, even if within the subsectors. they're somewhat homogeneous. But we've gotten to a point where some of these constituencies are exactly on the opposite side of this issue, Hamas and Israel, and it's sort of starting to fall apart. And it's sort of metaphoric for the tensions that are clearly building within the country. How many times do you read our institutions are falling apart? I used to talk about how that would become a #1 news item. I talked about it 15 years ago, but now people are saying it out in the open. You know, people don't believe in churches anymore. People don't believe in the Justice Department to the extent that they used to. People used to think the FBI was absolutely, you know, unquestionably excellent.
And now, but the former president, in some ways, some would suggest is the one who is attacking the institutions and criticizing.
Oh, I don't think there's any one source of this. I think it's just a fact that we have so much wealth inequality and we have so much power that's concentrated in an ever smaller group. And people are starting to realize that they're being ignored by what they used to think was the establishment. This is a lot like 1968. I did a webcast yesterday, and I entitled it 1968 because I was talking about how the lack of cooperation that led to a lot of difficulties around that time period are in evidence today. And I think it's sort of the volatility of our perceived reality. You know, when you're a kid, at least when I was a kid, you think that everything's going to be the same forever. Nothing will ever change. But things always change. And then you get to my age now, I'm going to be 65 this year, you realize nothing's off the table. Everything can change. And I think everything will change in the next 4 to 6 years.
Given your concerns about the deficit, the former president wants to double down on the tax cuts.
Yeah.
They're going to expire. He wants to renew them. Would that be a good or bad idea?
I think it's a bad idea. I think to expand the deficit at even a higher rate than we're doing right now is suicidal.
Perhaps $4.5 trillion, according to some estimates.
In a fiscal year. Yeah, well, right now we're running at $2 trillion. So then the interest expense...
That would add, renewing the tax cuts would add $4.5 trillion to the deficit, according to the Senate Committee on the Budget.
Over what time period?
They
usually use 10 years. I'll take the...
But nonetheless, it expands the deficit.
Absolutely.
And you think it would be a mistake?
And the interest expense, absolutely. And I think the interest expense is underappreciated. It's getting more attention, but it's underappreciated. It's going up a lot and higher for longer. And one cut instead of 3, if we're going to use that as a base case, that just means that the interest expense is going to go much higher. We're going to be over $1 trillion in interest expense soon on the deficit. And when a recession comes, historically, in the old days, the deficit would go up by 4% of GDP. Weird situations with the pandemic, it went up by 9% of GDP on average. But let's just take the middle of that and say it goes up by 6 percentage points. We'd be looking at $3.5 trillion per year. And that is not serviceable. And so we're going to have to work on solutions. And that's going to involve restructuring the unfunded liabilities, and it's going to be interesting to see how they manage the Treasury debt, because they made a big mistake when interest rates were held at 0 forever and long rates went down to about 1.5% to 2%. They should have borrowed at those levels, but they didn't, because 25 basis points was cheaper than 1.75%, and it's always short-termism. But we should have planned on that, and we'll see what happens as this stuff comes rolling off. I'll just remind everybody, we have between this calendar year and the next 2, $17 trillion of treasuries that are being refinanced. And many of them are going to be 400 basis points higher. Big issue. I doubt it will affect this presidential election, but it's going to be front and center in 2028.
We will see you next Fed meeting. I appreciate you having us here at your headquarters in Los Angeles. That's Jeffrey Gundlach of Double Line Capital joining us live. Thank you.
Thank you, Scott.
Up next, another